Last month, we highlighted that, to our mind, a decisive turn in the US dollar had been seen. On a DXY index basis, the US dollar was essentially unchanged at around 100 in April and May as our Market Outlook publication went to press. But for the June edition, DXY sat at 96, almost 4% lower, a level that has broadly been sustained since. What changed in June for the US dollar? Primarily, the move came as a result of optimism amongst investors over the global recovery from COVID-19, and consequently a greater willingness to take on risk. The provision of extraordinary stimulus by the US FOMC and other central banks across the globe was pivotal. So too a steady stream of market whispers around progress towards a vaccine. That this level has since held despite escalating risks across the globe emphasises a strong desire amongst market participants for a robust recovery. Paradoxically, it seems that the market is more focused on the rate of economic reopening than controlling the virus, particularly for the United States. Despite an outsized broad-based surge in new cases in the US, which shows no sign of letting up, both euro and sterling lost ground this month, even though Europe and the UK are successfully restricting the virus's spread. Inevitably, the distinct difference between these jurisdictions in containing COVID will matter to markets, seeing euro and sterling move higher to 118 and 130 respectively, from 113 and 126 currently. On a DXY basis, the US dollar will conversely depreciate around 3% from 96.5 to 93.4 in December 2021. With the balance of COVID-19 risk skewed against the US, a quicker or larger fall in the dollar is a distinct possibility. The polar opposite to the US's plight is the promise of Asia, best highlighted by China's progress. With the threat of an outbreak in Beijing seemingly quashed and evidence of a strong rebound in economic activity continuing to build, the US dollar has moved materially lower against the renminbi over the past month, from above 706 at the time of our June market outlook to below 7 currently. We expect a further move lower in 2020 to around 690 and then to near 660 as 2021 concludes. Note, this endpoint is still materially higher than the 630 seen before US-China trade tensions took hold in mid-2018, so there is certainly room for downside risks around the US dollar to play through here as well. Australia's own currency is expected to benefit from our proximity to Asia, their initial recovery from COVID-19, and sustained growth in consumer incomes and spending. Additional support for the Australian dollar will also come from the limited spread of the virus within our borders, and consequently a timely and sustained rebound in our own economy. To our mind, these factors will see the Australian dollar at 72 cents against the US dollar by year's end, and then 76 cents come December 2021. As a final thought, it's worth emphasising that Asia and Australia have not eradicated the virus, and so there are still risks. The most immediate evidence of this for Australians is the outbreak in Melbourne. But from an economic perspective, the rapid rise in the case count in countries like India is the bigger threat. Here, however, we must distinguish between growth and FX consequences. While these developments produce growth opportunities for the region, the impact is not equal. It is these growth and risk differentials that dictate FX dynamics, not the quantum of growth overall. Within the region, the outperformance of China and Australia will support our currencies versus others like India's rupee and also against the US dollar. We'll see you next week.